All right, thank you very much for joining me here today. I'm Don Ma. In the last episode, I mentioned that we'll have a new design today. It's not quite ready, so I'm still using the old setup. Hopefully, it's going to be ready on Monday. It looks amazing, and I can't wait for you guys to see it. All right, our first story today. Renewed efforts seems like are underway in China to win back foreign investors and boost its struggling economy. Chinese Communist Party leader Xi Jinping met with more than a dozen American CEOs and academics to advocate for continued investment in China. The foreign ministry said that Xi also called for a better future between the two nations, but confidence in China right now is weak. From global executives, foreign direct investment shrank nearly 20% in the first months of the year compared to a year ago. Businesses as well and investors are wary of regulatory crackdowns amid intensified national security laws and slower growth. Xi is attempting to boost the economy by shifting focus from its troubled real estate market to manufacturing. But experts don't see manufacturing being able to actually close the gap with China's property investments, and other countries as well are already on alert that China's industrial dominance could overflow the market with low-cost, high-tech exports. But besides that, staying with China, its currency, the yuan, is sliding, and there's growing speculation that this is an intentional move to remain competitive in exports. Analysts expect that Chinese authorities are deliberately engineering a light depreciation of the yuan. The Chinese currency has become relatively less competitive as Japan's yen and neighboring currencies, for example in South Korea, Thailand, and Taiwan, have taken sharper hits. The yuan has declined roughly 2% against the dollar this year. Compare that to Japan's 7% drop. And this is causing China to be less competitive and allowing others to gnaw away at its export industry. This comes as China is facing an uneven economic recovery and is facing mounting financial challenges in other industries like its real estate market. And Chinese electric vehicle giant BYD reported an 18.6% rise in fourth quarter profits. It's the lowest since the first quarter of 2022. This is as EV sales lost momentum in the world's biggest auto market amid a brutal price war. Take a look at this.
BYD posted its slowest quarterly profit rise in 2 years on Tuesday. It comes as electric vehicle sales lost momentum in China due to a price war. The Chinese EV giant reported an 18.6% rise in fourth quarter profit. Net profit totaled $1.2 billion and revenue was up just over 15%. The automaker overtook Tesla as the world's top EV seller in Q4 after relentless discounts, and it's taken an even more aggressive position this year. BYD on Monday set the starting price of a new version of its Seal electric sedan 5.3% below that of its predecessor. Last year, BYD cut the prices of 13 models. Several other automakers have joined the price war this year, including Tesla, Geely, Xpeng and more. But those discounts are smaller than BYD's in terms of their depth and the number of models. Analysts see BYD's discounting eating into its domestic profit margins, though they believe this could be largely offset by the carmaker's strong cost control and its growing higher-priced exports. Industry data showed China's EV sales grew by a fifth last year, compared to a 74.2% rise in 2022.
And let's talk about another Chinese company, Xiaomi. The CEO said that his goal for the firm's first electric vehicle was that it would be the best looking, easiest to drive, and smartest car. It's going to be priced below 500,000 yuan, which is about $69,000. And this is as the Chinese electronics maker gears up for orders this week. Here's the story.
Xiaomi is getting closer to taking orders for its first EV. The Chinese firm, better known as a phone maker, began displaying its cars in showrooms on Monday. It also hinted at a price for the electric sedan, dubbed the SU7. Chief Executive Lei Jun said it would be the best-looking, easiest-to-drive car priced below 500,000 yuan, or just under $70,000. That was the first time the company had indicated an upper limit for the vehicle's pricing. Full details are set to be released on Thursday evening, when orders will also start to be taken. Anticipation over the EV has been building since it was unveiled in December. It's the first step in an ambitious plan for Xiaomi to become one of the world's top 5 car makers. Lei says the vehicle beats rival products from Tesla and Porsche on acceleration. Now Xiaomi says it will invest $10 billion in developing cars over the next decade. It wants to diversify away from a flagging market for smartphones. And it's not the only Chinese tech firm thinking about cars. Rival phone maker Huawei and search engine giant Baidu have both partnered with local automakers. But they enter the sector at a difficult time, with China's EV market in the middle of a fierce price war sparked by Tesla.
And Alibaba Group said that it was offering to buy the remaining stake of Cainiao it does not own already for up to $3.75 billion, abandoning plans for an initial public offering of the logistics business in Hong Kong. Here's more.
Alibaba Group is scrapping plans for a Hong Kong IPO of its logistics unit, Cainiao. The move is the latest reversal of its massive restructuring plan, which had split the company into 6 units. On Tuesday, the Chinese e-commerce giant said it's instead offering up to $3.75 billion to buy out the 36% stake it does not already own in Cainiao. Group Chairman Zhou Tai said there was significant long-term opportunity in building out a global logistics network, saying the firm had decided to double down on the business. He also told analysts that regulatory issues played no part in the decision to pull Cainiao's IPO. The Hong Kong IPO market slowed 56% in 2023 from the year before. According to sources familiar with the matter, Alibaba had faced a mismatch in valuation expectations with potential investors. The company did not immediately respond to a request for comments on any such issue. In a statement, it said it aims to complete the buyback by June or July. According to Tsai, the company wants to, quote, win in e-commerce by regaining market share and driving growth, adding that further integration with Cainiao is central to that strategy.
Now here in the U.S., Krispy Kreme said its donuts would be available across McDonald's U.S. restaurants by the end of 2026 as the companies expand a pilot project, sending its shares surging. Take a look at the details here.
Talk about a sugar high. Shares of Krispy Kreme were on track for their biggest daily percentage gain ever on Tuesday, after the company said its donuts would be available at McDonald's restaurants across the U.S. by the end of 2026. The two food companies have been testing the program at 160 McDonald's locations around Lexington and Louisville, Kentucky, since October of 2022. They will roll out the program in stages beginning in the second half of this year. McDonald's has about 14,000 stores nationwide. As part of the agreement, Krispy Kreme said it would not supply its donuts to any other fast food restaurants in the U.S. through the end of 2026. Krispy Kreme has been aiming to expand its distribution to at least 75,000 locations globally, such as quick-service restaurants and grocery stores. The move is not only a boon for the donut maker, but for McDonald's as well, which has suffered from flagging sales overseas.
Now, prices for everything else feel like they have gone up, but Costco continues to hold the line on its hot dog soda combo. The $1.50 deal has been the same price since 1985. Now, take a look at this. The price has remained the same, weathering through the Great Recession, the housing crisis, the pandemic, and decades-high inflation. If the price actually kept up with inflation, the combo would cost closer to $4.50. Experts say Costco won't change the price because it's a loss leader, and what that means, it loses money on hot dogs to keep customer loyalty high and for its branding as well. Costco's unique membership business model also puts it in a position to sell items at cost or even sometimes less. Costco's hot dogs have continued to defy inflation, as I mentioned earlier, which has slowed considerably since the peak in 2022. Last year, Costco sold $195 million worth of hot dog soda combos around the world. And speaking of hot dogs, fast food chains are seeing a slim down in its core customer base. Low-income diners are skipping the drive-thru to find better deals, it seems like. Low-income customers make up a significant portion of the customer base for fast food companies, but budget-conscious diners are cutting back because of rising food prices. From 2021 to now, prices have spiked 20%. The fastest jump on record, by the way. A poll found out that about a quarter of low-income customers were eating less fast food. Chains are unlikely to offer broad price cuts to win back these customers since price increases have kept their sales consistent overall, and some Taco Bell locations in Texas have even been doing well. Instead of slashing prices, analysts expect fast food chains to be selective and offer deals through specific channels like in their apps. And thank you very much for watching today's shortened episode of NTD Business. We'll be back on Monday with a whole new look and a new name as well called Business Matters. See you then.